Index funds, mutual funds, hedge funds, ETFs, they sound like they belong in the same investing toolbox. But choose the wrong one and you could be throwing away years of growth. Or watch your hard-earned savings leak away, quietly, year after year. The truth is, each of these funds has its own purpose, its own risk level, and its own cost structure. And here's the twist most people never see coming. The one your bank, your broker, and even some finance gurus won't rush to tell you, the fund type you think is the safest could be the one silently costing you the most. By the end of this video, you'll know exactly how each fund works, how it makes money, the risks you face, the fees you might pay, and most importantly, which one actually fits your financial goals. Here's why this matters. Over 58% of Americans own stocks, mostly through retirement accounts, and the majority of those holdings are in funds. Yet, according to the SEC, most investors can't explain how their fund works or what they're paying in fees. And that ignorance comes at a cost. Choosing blindly can lead to higher fees, lower returns, and unnecessary risk. And if you think this is just a beginner's problem, think again. Even legendary investors like Warren Buffett, Ray Dalio, and Jack Bogle have spent decades debating which approach is best, and their opinions might surprise you. Think of it like planning a trip with friends. Everyone throws money into one pot for travel, food, and activities. But how you decide to manage that money changes everything. Do you hand it to one friend who claims to know all the best spots? Do you follow a guidebook word for word? Do you let a risk taker bet the entire budget on a poker game? Or do you give everyone a flexible pass to explore on their own? That's basically the difference between these four types of funds. Stick with me, because you're about to learn why index funds have made millionaires out of patient investors, why some mutual funds are quietly draining people's savings, why hedge funds are both loved and hated by the rich, and why ETFs have exploded in popularity over the last decade. And by the time we're done, you'll understand exactly why the fund type most people believe is the safest might be the one quietly eating away your returns year after year. But before we dive into the big differences, we need to start with the foundation. What exactly is a fund, and why do they exist in the first place? Before we compare the big four, we need to start at the very beginning. What exactly is a fund? A fund is simply a pool of money collected from multiple investors, managed as one big pot, and then invested in a variety of assets like stocks, bonds, real estate, or even commodities. Instead of you buying and managing each individual investment yourself, the fund does the heavy lifting for you. And in return, you own a slice of the entire portfolio. Think of it like hosting a birthday party with friends. Instead of one person paying for everything, food, drinks, decorations, music, everyone chips in. With that combined budget, you can afford more, and no single person has to carry all the stress or cost. In the investing world, this pooling of money means you can diversify without needing a huge amount of capital. You can invest in areas you might not have access to on your own, and you hand over the day-to-day decision-making to the fund itself. Sounds simple enough, but here's where it gets interesting. Not all funds are managed the same way, and the way they're run affects your risk, your returns, and how much of your profit you actually get to keep. Let's start with index funds, probably the most talked about in personal finance. You've likely heard advice like, just throw your money in an index fund and forget about it. But what does that actually mean? An index fund doesn't try to pick winners and losers. Instead, it copies a preset list called an index of companies or investments. An index is like a scoreboard for a specific part of the market. There are indexes for almost everything, from small companies to international markets, to specific sectors like energy or healthcare. Here's the key. Index funds are passively managed. That means no one is actively deciding which stocks to buy or sell. The fund simply follows the index's exact list. Because there's no expensive manager calling the shots, fees are extremely low. We're talking 0.02% to 0.20% per year. If you invested $1,000 in an index fund with a 0.02% expense ratio, your annual fee would be just 20 cents. Yes, cents. Index funds are also well diversified by design. If one company in the index has a terrible year, the others help balance it out. That's why they're considered relatively low risk, at least compared to picking individual stocks. There's one thing to know about buying and selling index funds. They're priced only once per day, after the market closes. That price is called the net asset value, or NAV. If you buy at 11 a.m., you won't know the exact price until after the market closes. For long-term investors, this delay doesn't really matter, but it's important to know. So you're not expecting second-by-second price changes like you would with a stock or ETF. So why are index funds so popular? Because they tick all three boxes for long-term wealth building: low cost, low maintenance, historically strong performance over decades. Even Warren Buffett has famously said that most investors would be better off putting their money into an index fund than trying to beat the market. But as good as index funds can be, they're not the only option. Some people want more control, more flexibility, or believe they can beat the market with the right strategy. That's where mutual funds come in, and they work very differently. On the surface, mutual funds look a lot like index funds. They pool money from many investors, spread it across a mix of assets, and give you diversification. But here's the big difference. Mutual funds are usually actively managed. That means there's a professional fund manager, sometimes a whole team, making decisions on what to buy, what to sell, and when to do it. The goal? To beat a benchmark, choosing the right investments at the right time. Sounds great in theory, but there's a catch. Active management means higher costs. Mutual fund fees, called expense ratios, often range from 0.5% to 1.5%, and some are even higher. That might not sound like much, but over 20 or 30 years, that difference can eat away at tens of thousands of dollars from your returns. And here's the uncomfortable truth. Studies show that the majority of actively managed funds fail to consistently outperform the market over time. In other words, you're paying more, and statistically, you're unlikely to get better results. So why do people still invest in mutual funds? Some believe in a specific manager's strategy. Others want access to markets or sectors that aren't well covered by index funds. And in certain workplace retirement plans, mutual funds might be the only option available. Just like index funds, mutual funds also only trade once a day, after the market closes. So you can't jump in and out at a moment's notice. Mutual funds can work for some investors, but they're still playing within fairly traditional rules. If you want to talk about breaking the rules and taking big risks for potentially massive rewards, we have to talk about hedge funds. The word hedge might make them sound safe, but in reality, hedge funds are some of the most aggressive investment vehicles in the world. They're private funds that pool money from wealthy individuals and institutions, then use high-risk, high-reward strategies to chase bigger returns than the market average. We're talking about short selling, betting on stocks to go down, leverage, borrowing huge sums to invest even more, derivatives, complex financial contracts that can multiply gains or losses. Hedge funds aren't for the average investor. They're usually only open to accredited investors, people with high incomes or net worth. And they're famous for their fee structure, 2 and 20. That's 2% of your total investment every year, plus 20% of any profits they make for you. So if a hedge fund makes you $1 million, they take $200,000 of it on top of the regular management fee. That's why hedge funds aim for spectacular returns. They have to make it worth the cost. But remember, with higher potential reward comes much higher potential risk. Hedge funds can and do fail spectacularly. Hedge funds as a group have struggled to beat simple index funds. Most everyday investors are better off with something lower cost, easier to trade, and accessible to almost anyone with a brokerage account. That brings us to ETFs. An ETF, or exchange traded fund, is like a hybrid between an indexed fund and a stock. Like an index fund, it can hold hundreds or even thousands of assets for diversification. But like a stock, you can buy and sell it all day long, whenever the market is open. This gives ETFs flexibility that traditional index funds don't have. You can see their price change in real time, set buy or sell orders, and even use them for short-term trades, though most people use them for long-term investing. Most ETFs are passively managed, tracking an index just like an indexed fund would. That means low fees, often between 0.03% and 0.75%, depending on the type of ETF. They're also widely available through online brokerages, often with zero commission fees. In the last decade, ETFs have exploded in popularity because they combine the low cost and diversification of index funds with the flexibility of stocks. For many investors, ETFs are the perfect middle ground. Simple enough for beginners, but versatile enough for experienced traders. So now you know how each type works. But here's the million-dollar question. Which one should you choose? Because picking the wrong one for your goals isn't just a bad decision, it could be the most expensive financial mistake you ever make. Let's break it down. Now you know what each type of fund is, but here's the bottom line. Choosing the wrong one can quietly drain thousands from your portfolio, and in some cases, cut your retirement savings in half. Hit like so more people can find it, and subscribe for our next deep dive.